Welcome to the first session of Financial Management and Costing. In this session, we will try to discuss the following objectives. We will try to define what do you mean by financial management. Then we will also try to explain what are the various sources of funds. Then we will go to the discussion of important types of decisions a financial manager takes. And at the end, we will try to discuss the brief overview of financial management along with what should be the goal of financial management. So before beginning, let us have a look at the syllabus of financial management and costing. So as we see the structure, financial management costing comes under the elective one. It has got 4 hours of theory per week, 30 marks of INSEM, 70 marks of ENSEM, and it has got term work of 50 marks, and in all 4 credits are given to the subject. Now going to the detailed syllabus, there are 2 sections. The first section is on financial management, which we are starting today in this session. So unit number 1 is on financial management, which contains the sources of finance, the discussion on balance sheet, profit and loss account, cash flow analysis. Then second chapter is detailing about some of the functions of financial management like capital budgeting, and unit number 3 is on working capital management. Section 2 covers the costing part, that is costing. Then the next one is standard costing and variance analysis, and the last one is on types of costing methods. Okay, so what are the books which we are going to refer? Section 1 we will be referring Financial Management and Costing by I. Pandey. In section 2 we are going to use Cost Accounting Methods and Problems by B.K. Bhar. So let us begin with our session, first session, the definition of financial management. It is that managerial activity which deals with planning and controlling the firm's financial resources. So financial resources means what we say is all kinds of equipments which we procure, land, copyrights, patents, raw material, or any kind of financial resources which we have acquired through spending of the money, and which is used to convert raw material into the finished products, and again you get back the cash. So everything comes under financial resources. So planning and controlling these financial resources is nothing but the purview of financial management and costing. Now if we look at the scope of financial management extends to all the departments, because when you procure the funds are utilized for purchasing the raw materials, machines, or any other facility which is used to convert the raw materials into finished products, and marketing, or giving out a service, and again trying to market about that service and trying to achieve some profit. So the financial management basically it is all the different departments, and we can't see financial activity in separation. Now going to the second point, what are the various sources of funds a firm generally goes for? There are broadly 2 sources of funds. One is the equity and the second one is the debt. So equity by means the firm floats the shares in the primary market, and the people who are interested in investing in that firm, they purchase those shares. These shares obviously can be traded in the secondary market. So this is one way of raising the funds. And the second way is through borrowing the funds from the financial institutions like banks, non-banking financial institutions, or other financial institutions. So now what is the difference between these two is equity is the firm's own fund, and generally there are two types of shareholders. One is called as the ordinary shareholders, another is called as the preferential shareholders. So preferential shareholders, they get a dividend at a fixed rate, and the ordinary shareholders, they get a dividend rate not at the fixed rate. And one of the factors, giving dividend is not compulsory. If the company decides that they don't want to give dividend, it's up to them. It is not legally binding on them. But whenever they give a dividend, the dividend is not deductible under taxes, on the taxes. But on the other hand, the debt, whatever interest we are paying on the borrowed fund to the financial institutions, that interest is deductible from the income tax. Okay, so there has to be a proper balance. We will never see that a company goes for a complete equity for raising the funds or complete borrowed funds for the raising of the funds. So this much is sufficient to understand what are the sources of funds. More will come in the subsequent parts. Now coming to the what are the various types of decisions a financial manager has to take. Broadly, they are classified into two. One is long-term decisions and the second one is short-term decisions. So under the long-term decisions, we have investment decisions, financing decisions, and the dividend decisions. And the short-term decisions are termed as also liquidity decisions. So trying to briefly discuss each one of them. Investment decisions, they involve capital commitment to long-term assets that will yield benefits in the future. So two important aspects are prospective profitability of the investment has to be found out, because these are very huge amount of funds which we are going to utilize in these decisions. And that's why we are also supposed to have a cutoff rate to measure the profitability of the investment. Okay. And another aspect is that it also involves replacement decisions. Like whenever you purchase a very big machinery or you are investing in a big facility, over a period of time, everything has a depreciation. After its life has been depreciated sufficiently, we need to replace that. So that replacement decisions also have to be considered when you are evaluating the profitability of the investment. They say there is some residual value to the scrap machine or scrap facility. So that also has to be included while you are trying to find out the profitability, or we are trying to assess the profitability of the various options. So now here in this investment decisions, which are also called as capital budgeting decisions, we are going to discuss in more detail in unit number 2. So in all the methods which are used for evaluating the investment decisions, there is one term which is called as cutoff rate, which is also related to required rate of return, and it is nothing but an opportunity cost of the capital. So what does it mean? Suppose we have an X amount of capital, and when I put it as a fixed deposit in some of the financial institutions, I get a interest rate. I get a return on that fixed deposit at an X rate. Say generally we assume that it's an 8%. Now suppose instead of putting that into FD, suppose I have several options of investment. I evaluate them. I find out the best investment option, and I, instead of putting it in FD, I invest that money into that investment option, and I take some efforts generating the profits. So at the end of all this exercise, suppose if I don't get the rate of return which is higher than what FD was giving me, then my whole exercise is useless. It was not actually beneficial. So this required rate of return is the base line, and we target for a rate of return which is higher than this opportunity cost of capital. Okay, that is also called as a cutoff rate. Okay, so more we'll discuss in detail in the second unit. But I hope investment decisions involve a good amount of capital investment and number of options which are available at any point of time have to be evaluated, and one of the important point to be considered while evaluating the investment decision is cut-off rate, which is nothing but opportunity cost of capital. Now, going ahead, why these investment decisions are so important? Because of these characteristics, they are the decisions which are going to affect for more than a year. Means when you take a decisions like of expansion or launching a new product or a new business or starting your business in a new area where you are not entered. So all these things require a huge amount of money, and those are going to have any positive or negative impact for a number of years down the line. And that's why they are also called strategic decisions, which are taken by the top management. And this affect the performance and value over a long term. Right. So that's why these are very important kind of decisions. Now, second, this one type of decisions are the financing decisions. So financing means how do I raise the funds? So briefly, we had discussed it in the last point, last to last point. But here we'll see some more details on that. There is a term called as capital structure. So capital structure means an appropriate mix between the two ways of raising funds. As we have already seen, one is equity, another one is debt. So how much fund is raised through debt and how much fund is raised through equity? That mix is called as the capital structure for the firm. Now the step one in financing decision is determining the optimum capital structure. Now optimum capital structure means what? When you have an appropriate mix of equity and debt. In that case, the profitability of the shareholder is maximized. And when it will be maximized, it will be reflected in the share price of the firm. So when the share price of the firm increases or maximizes with a particular mix of debt and equity, that is called as the optimum capital structure. Now let us try to understand. When debt component is nil, that means everything is raised through equity. In that case, the shareholders' return is equal to the return of the firm. Okay, but suppose we get some debt component into it, so debt is going to affect the risk and the profitability of the shareholders. Now, in what way? When you add some debt component, the profitability increases, but that also increases the risk. Okay, so the that is called as the financial leverage. Okay, to the degree the profitability of the shareholder is affected by the presence of the debt, or say the particular mix of the equity and the debt, that is called as the financial leverage. Okay. Now, once you have decided how much, that is the appropriate or say the optimum capital structure, how much you are going to raise through equity and how much you are going to raise through debt, then the second step is in equity, there are a number of best available options. Like we know, ordinary shareholders and the preferential shareholders. So now how much you are going to raise through preferential shareholding pattern and how much you are going to raise through ordinary shareholder pattern. And if you're talking about debt, how much you are going to raise from financial institutions. There are mutual funds, there are NBFCs, there are bonds, debentures. So once you have decided the optimum structure, how much equity, now how you are going to raise that equity fund with the best available options under equity domain. And the second one is how much debt you have already decided in step one. Now how much that amount, how that amount is going to be raised through different best possible avenues under debt market. So that is what is involved in the financial decisions. So the dividend decisions, which are discussed in this next slide. Dividend decisions involve these 3 points. Now, before that, try to understand what do you mean by dividend. The firm's own profit, and when the profits are distributed to the shareholders, that is termed as dividend. Now, as we already discussed, giving dividend is not compulsory. There are a number of companies which do not give dividends. There are companies which give dividend once in a year. There are companies which give dividend twice in a year. So it totally depends on the company decision. So, but in general, the profits when are distributed to the shareholders, it is called as dividend. Okay. So now, obviously, the total profits are never distributed to the shareholders. Some portion is always retained, some portion is distributed. So now, depending on that, there are two terms. One is called as dividend payout ratio, nothing but amount of the profits which are distributed to the shareholders. And the retention ratio is nothing but the amount of profits which the company retains with themselves for the future expansions or using it for their different purposes, which are again going to reflect the shareholders' maximization. Okay. So now dividend decisions, dividend policy also should be an optimum one, which ultimately will affect the shareholders' profitability in a positive way that is shown in the form of increasing or maximizing the share prices of the firm. Okay. Now, it's not that always the dividend is given in the form of the cash. It also could be given in the form of the bonus shares. The bonus shares means the shares are given to the existing shareholders without any charge. So if they are holding X amount of shares on say 100 for 100 shares, they are given some shares extra. It is also a form of giving a dividend instead of giving a cash dividend. Okay. So these are also important decisions. Now the last type of decision is the liquidity decisions, which is coming under short-term decisions. So the first point you have to understand is that liquidity decisions are the decisions which involve a period of less than 1 year. Okay. Now it is concerned with day-to-day requirements. As we all know that there are salaries to be paid, there are bills to be repaid, there are raw materials to be purchased, tools, and there are contingencies, emergency expenditures. So all these things require some cash component at hand always. We can't keep everything invested in long-term instruments. So that aspect which requires cash for addressing this kind of issues is termed as liquidity decisions. So how much liquidity has to be maintained? Okay, so you require funds for managing current assets. Current assets means the things which are going to be converted into cash in less than a year. And there are current liabilities. Liabilities means the suppose you have taken some raw material from a supplier, but you have not paid him. So within 2-3 months down the line, you are going to pay him. So it's a liability which is going to be which is going to become due in a period less than 1 year. Okay, so assets are, say, for example, raw materials. Raw material is a kind of an asset which is going to be converted into in-process goods, the in-process goods to the finished goods, then they will market it. And when you sell it in the market, it gets converted into cash. So it's a cycle with this. So raw materials are again going to get back into cash within a period of less than 1 year. So it's a form of a current assets. So managing current assets, current liabilities, then there are short-term borrowings. Short-term means there are long-term loans which we take from the financial institutions. There are also called as working capital loans. Okay, so working capital is another term used for this liquidity. This we are going to discuss in detail in the third unit. It is working capital management. And the fourth point is that we also earn something out of long-term assets, like when you sell a big facility. So for the short duration of time, we invest that amount in somewhere for a short duration. Okay. So investment of surplus funds for the short duration, that is called as that is also included in liquid assets. Right. Now coming why it is important. So it affects the profitability and liquidity. Now how does it affect profitability and liquidity? Suppose if we do not have sufficient cash at hand to meet the obligations like managing the current assets, current liabilities, short-term borrowings, and investment of a surplus for a short duration of time. If we don't manage them properly, that means we don't have proper cash to meet the liabilities. The company may face illiquidity or it may become bankrupt. Okay, that it is not able to meet the bills payable in time of several suppliers. Okay, so it may lead to insolvency or illiquidity. Okay, so that situation is not desirable. Neither a situation where you have too much of liquidity, because the capital which is not invested properly is a waste of capital. You are not earning anything on that. Okay, say X lakh rupees, if we have not, if you have just kept it in hand without investing it properly, you are losing. We are losing on the cost of capital, cost of the opportunity, cost of the capital, as we already discussed. Okay, so there has to be a proper balance. Too much of liquidity is also not desired, or too less of liquidity is not desired. Too much of liquidity leads to reducing the profitability, and too less of liquidity may lead to insolvency. So both the situations have to be avoided. Okay. So there is a term called as profitability liquidity trade-off. So there has to be a proper balance between liquidity and the profitability. Okay. So here we end. In the subsequent sessions, we will discuss about what should be the goal of financial management, whether it should be profit maximization of the profit. Now, profit is a very vague term, whether that profit is before taxes or after taxes, or is there any something else which has to be the goal of the financial management. Thank you very much.